Hello and welcome to Bloomberg Quint. Agam and I are here to wrap the markets for you. And this time we do have with us Rahul Arora, the CEO at Institutional Equities team at Nirmal Bang, who's going to be joining us, and we will come to him for that. But Rahul, I'm just going to give a brief about how the markets and the Nifty has done today before we really come to you. So it's been a great start to a week. Nifty crosses 8900 for the first time in the last 18 months is what the focus really here is. So we're really playing some sort of a catch up to the good rally that we saw in emerging markets yesterday. Monday was a holiday for our markets, but the Asian stocks were hovering about 1 year highs. Of course, on Friday, post-market here, we had the US jobs data coming out, a weaker than expected number, which only reduces the prospects for the Fed to hike rates in its September meeting. So that probably has been the reason for the kind of up moves that we have seen. If I talk about what has really driven this 120, 130 points rally today, it's the banks and the auto stocks. So Paris Bank and auto, this has been the more or less the broader trend. These are the sectors which have been doing well of late. The broader markets also, the breadth was positive. 3:1 was the kind of advanced decline ratio on the Nifty 500 index. On the debt markets front, well, the 10-year bond yield is down about 2.5 basis points. You have the new RBI Governor Urjit Patel, who started his new term. The rupee was trading stronger by about 28 paise. So overall, it seems to be a good day as far as all your commodity and debt and currency markets are concerned. But Agam, what are you noticing on the F&O front, and where is the put activity concentrated?
So just a couple of points on the futures and options space. Firstly, when it comes to the indices, the Nifty is added about 3.5% towards open interest. Similarly, the Bank Nifty is also added about 10 to 12% towards open interest. But do remember, these are provisional numbers. We will have the final numbers come in the Bhao copy. That's in a couple of hours from now. But we most certainly have seen fresh buying in both these indices. Coming to the options data, let's take a look at what's happened today. We have seen an unwinding, predictably, because of the fact that the Nifty has gone up, unwinding in the 8900 calls, and we've seen a lot of writing, substantial amount of writing in the 8900 put. That brings me to the maximum distribution in open interest between 8600 put as well as a 9000 call. So that remains the broad range for the Nifty, at least as far as the September futures go. And once again, we'll have to wait and watch as to where the Nifty takes us, which will also determine the change in the futures and options space, Shraddha.
Okay, Agam. So I think now we should bring in Rahul. And Rahul, my question is, we are about 170 odd points away as far as the Nifty is concerned from the 9,119, I think was that the high that we had seen in March 2015. We're just about less than 200 points away. Of course, it has been a liquidity driven rally, but is this sustainable, and where do we head from here?
So obviously, I think the markets have reacted very positively since the budget day lows. I think you've gone up about 25-30% on the Nifty, and it's predominantly been driven by the Bank Nifty, which is up close to about 45-50%. I think the sort of initial phase of the rally was driven by three major factors. One was the hope of GST going through, the earnings and the monsoon. I think by and large, a lot of that has played out. I heard you allude to the 10-year bond yield. If you see, it's flirting with about 7% right now. One conventional economic way of looking at where the market multiple should be is you take the inverse of the 10-year bond yield, and that'll probably tell you that the market should be at about 14.5, 15 PE. And if you look at your very own Bloomberg consensus estimates for FY18 and juxtapose it on where the Sensex is closed today, it'll show you that the Sensex is trading at about 15 times FY18 earnings. So I'd say market is probably fairly valued given the domestic earnings potential that we have. The big sort of question mark or the joker in the pack is liquidity. If that continues, I think we could potentially take out the new high. But when we speak to our institutional clients, it's trying to get a little bit worried about where the market is, given the belying strength that you perhaps need to still see in earnings. It's not come through yet, but I think there's still a lot of hope and anticipation on that front.
Okay, Agam, I'm just going to bring you in here. Nifty is at about 8,900. What has changed, or what are really the movers from 8,900 level that we last saw and that we are at now?
So one may, consider some of these movers. We have a lot of banking stocks as well as a lot of auto stocks in among the gainers. So the last time we saw Nifty at around 8,900 was in March 2015. Since then, we have seen substantial gains in Yes Bank, up 66%. Z Entertainment are making gains around 57%. Maruti Suzuki, Eicher Motors, Bajaj Auto, and Hero MotoCorp. That's the point I was trying to make here. Where we've seen substantial gains in all these auto companies. Among the top 10 gainers in the Nifty, and IndusInd Bank, of course, among the other counters from the financial space. Among the losers, we have seen a lot of weakness in Bharat Heavy Electricals, Idea Cellular, Tech Mahindra, and Wipro. And as you can see, we have a handful of IT companies as well as pharma companies showing some amount of weakness through this period of 8900 in March to 8900 here. So, well, my next question to you would be, what are the stocks and sectors that you think could drive the Nifty forward from here on?
So I don't know how much legroom there is, to be very honest, in the Nifty from here on, but I think the fact that there was so much anticipation from the monsoon, I think anything that benefits from that is probably going to be something that you're going to see in earnings in Q2, Q3,
right.
Perhaps even maybe in the early part of Q4. So I'd still probably say consumption is a theme to play. I know valuations are probably optically more expensive than the rest of the market, and even compared to some of the other sectors, but I think FMCG could still be one place where you could see good earnings surprises in Q2 and Q3. I think pharma has been one space that's been beaten down, and I think most of the bad news that had to come through has already come through with the 483s being issued and the import alerts and things like that. So I don't think there's too much incremental downside over there. So I think these could be two potentials. They're probably polarized right now because one's been beaten down too much and the other hasn't corrected relatively, but I think one will see earnings support and the other has started seeing some valuation comfort. So I'd probably be more inclined towards consumption and healthcare as opposed to banks, which have seen, like we were discussing, a 45-50% run since the lows of the budget.
You said you're uncertain about the upside for now. Do you have any numbers that you're working with?
I don't want to get into specific numbers, to be very honest, but like I said, if you anecdotally go back and see markets, they generally tend to sort of trail earnings or project earnings and try and discount them either which way. So you look at trailing P and you look at forward P. On each parameter, I think we're just about where we need to be. I think the earnings growth perhaps needs to be 18 to 20% for both 17 and 18 to justify any incremental upside in the market. I don't think you're likely to get that in FY17. The big call is whether that will come through in FY18 or not. So I think any incremental upside from here is going to be determined predominantly on earnings.
Right.
Obviously, the liquidity push is strong, but I think any rally incremental from here on liquidity leaves us fairly vulnerable to a
Right.
pull-out.
Shraddha, you were looking at the earnings for the Nifty this time around. Tell us what you found, and if there are any questions that you would like you have for Rahul.
Just as Rahul mentioned, I was going to come to you on the earnings front. I just wanted to understand, how are you reading the Q1 earnings? You spoke about valuations and the fact that the Nifty earnings need to grow at about 18 to 20% to justify the kind of valuations that we're seeing. But any key takeaways from this earnings season, or anything where you saw a big positive or negative surprise?
I think by and large it was a disappointing quarter compared to where people were expecting to start of the financial year, to be very honest. I mean, cement was supposed to be one sector that was supposed to do well and has done well. But if you go back from October of last year to the start of the quarter, it's been a dream run for cement. The sector has been re-rated multiple times over. So I think most things on the domestic consumption side were expected to do well. That hasn't panned out. I think the general consensus is IT is going to continue disappointing. Our own house call is that trend growth could probably go down to as much as 5 to 7%, and that leaves further downside in IT. I don't think you're going to see immediate upsides in pharmaceutical earnings. The point I was making was more on valuation. I think the only place, like I said, where I would potentially see earnings upsides is probably the consumption-related sector, and maybe to some extent public sector banks, which have been beaten down. And I think some amount of the pain is already behind us. Now, it's tough to quantify whether that's 50%, 70%, but I think that could be one area of valuation catch-up that probably, you could potentially look at. But like I was telling Agam as well, I don't think that 18-20% growth, which we see as consensus today, is going to come through for FY17. But the base is by and large favorable with a good monsoon. I think that will probably has some tailwinds going into the next financial year.
Rahul, I do remember Nirmal Bang has been underperform on IT as a sector since the longest time, and that's actually playing out right now. But I will also discuss some mid caps. It's been a good day for the mid caps also, but of course mid cap stocks have risen. About the Nifty free float 100 index has rallied about 1.4%. That's the kind of gains it has seen today, but nevertheless underperforming the broader the large cap Nifty stocks, of course. But on the gaining side, we saw pharma stocks like Ipca. You have stocks like Jubilant Life Sciences that continues to hit fresh highs. Vakrangi Imami, some of the other stocks doing well. Indian hotels also saw good gains of about almost 6%. There was some news flow around the Taj Mansingh Hotel. But the more interesting moves really have been on Mindtree and Jubilant, down 4% and down about 9.5%, 10%. Very interesting thing that I read, Deutsche Bank had to say on Jubilant Foodworks after their earnings came out. They're saying the Jubilant does not disappoint in disappointing, and they call it an underbaked pizza. But so something really different that I've heard. But Agam, just how bad were the earnings?
Well, the earnings, let me just tell you how the earnings were. We've seen about a 6.6% growth in revenues. We have seen about a 31% decline in the net profitability. I think the one big number that everyone looks out for in Jubilant Foodworks is the same-store sales growth, which came at a negative 3.2%. And this is the first time you've seen a decline after 6 quarters for Jubilant Foodworks. But we had the conference call, and the management has suggested that they are expecting this number to turn into positive for the coming quarter. The other concern with Jubilant Foodworks was that this time around for Domino's, their store additions stood at 23 stores only, which is the lowest that we've seen in 20 quarters. And once again, the management suggests that when it comes to the target for the entire year of 130 stores, they are well in line and they should be able to achieve that target. That said, once again, we have seen a decline of as much as nearly 10% on Jubilant Foodworks. So the sentiment has most certainly, not improved. In fact, it has degraded. So we'll have to wait and watch as to what more brokerages make of Jubilant Foodworks. But I know that you're tracking one other counter in the same space. What do you have to say about that?
That was my question coming up for Rahul. Rahul, Jubilant Foodworks posted a same stores negative sales growth of negative 3.2% for this quarter. And I know that you have been positive on Westlife Development. So I just wanted to understand, just trying to correlate the two peer group stocks. Does this negative sales growth really worry you? And does it raise any questions in terms of the urban discretionary spending theme itself?
Well, actually, Jubilant's been one of our most high conviction focused buy ideas over the last 2 years. So it's been a bit disappointing. I mean, obviously the stock went up to nearly 2,000 and has corrected, and it's been a rank underperformer since then. But I think the fact that they reported a negative same-store growth in an otherwise improving economic environment was a bit disappointing. I do think valuations need to reset themselves. I have just come fresh off the conference call, so we haven't put out a revised note just yet, but I can tell you that we will definitely be downgrading our rating from a buy. Whether it will turn into an accumulator or a sell is something my analyst will probably have to brief me on. But I think in the context of what they have delivered, I think they'll be very lucky to get away with a 4% same-store growth this year. Preliminary numbers suggest that probably about a 7% growth next year. And if those are the kind of numbers you're looking at, then I don't see the stock doing too much over the next 12 to 15 months. As Agam said, the management has sort of indicated that the last 2 months of this particular quarter have seen positive same-store growth numbers, but I think to offset a minus 3%, you'll probably need something like, an average of about 5 to 6% every quarter from here for them to sort of keep the street enthused. So I don't think this is a stock to be owned from the next 12 months. I think the inherent quality of the business is phenomenal. You have to keep in mind that at the worst of times, it's managed to do a 20% ROE. So it's a good franchise. The online ordering is about 44%. Mobile as a percentage of that is 41%. So incrementally, these things will aid margins. So I have no concerns with the underlying strength of the business, but I think the horizon probably just needs to be a little longer than a year, which essentially means it's not a retail stock. I think it's still more an institutional investor held stock. And if you see the shareholding pattern of Jubilant, I think it's about 45-47% owned by FI. So I think there's a story somewhere in there. So a disappointment for sure, but I think if you're keeping a slightly longer term horizon, 2-3 years, maybe this might still be a stock to enter around 1,000. But I think if you have a 1 year horizon, probably not.
Okay, so the story is not here to what is what he has to tell us. If I again were to ask you just one question, if you had to choose between the rural consumption theme and the urban consumption theme, what would you be more bullish on?
At this point, definitely rural, because I think you're starting to see the pressure points in Indigo. You're starting to see the pressure points in PVR and Inox's earnings. You're starting to see the pressure points in Jubilant. So this entire theory of disposable income coming to the rescue of earnings for sort of urban-centric consumers, that's not really playing out. I think the rains during the sowing period have been quite phenomenal on a countrywide basis, and even subsequent to that. So I do respect the fact that August has been a bit deficient in certain parts, but I think the main part of the sowing period has seen very good rains, and I think that will bear fruit in the latter half of this calendar year, or rather this fiscal year's earnings. So anything that has a reasonable rural presence, whether it's a Dabur or an Imami or a Godrej, I think those would probably be better bets, and they'll probably show up. I think you might be even surprised to see Lever's numbers in terms of volume growth, for Q2 and Q3. So I think if the question is between rural and urban, I think probably a straight throw of the dart will be more towards rural.
Okay, so that was Jubilant versus the outlook, rural versus urban is what
But
you're
I
like
did
to say.
want to take on Westlife Development then in that case.
Again, I have no problems with the inherent business. So let's put it this way. So the Western fast food market in India is about $1.5 billion. This number at some point will become $5 billion just because of the demographics that we have. Whether that will happen in 3 years or 5 years, I don't know. But just the inherent strength of the franchise of Domino's and McDonald's, these would be the two brands that will drive it over there. Now, whether that comes at a substantial sort of impairment of margins or not remains to be seen, but that top line will essentially get there. See, the problem with McDonald's has been that it's more an eat-out kind of a destination. So till you don't necessarily go to a mall, or if you're not traveling on a busy expressway or a highway, you will not essentially consume it. It's more an impulse product rather than Jubilant, which is a more planned product. Just to give you an example, if your office had to plan a party, you would tell everyone there's pizza for lunch tomorrow, but you wouldn't do that with McDonald's. So the mindset of these two businesses, they're both QSR, but I think you have to approach them very differently. If the mall culture picks up, if more people start to go shopping, instinctively you will see that McDonald's will report better same-store growth than a Domino's, because McDonald's even has that additional advantage of having started delivery now, whereas it is already 45% of Jubilant. So I think you need to keep that in mind when you're looking at the two franchises.
Let's move on to Mindtree, because that was another talking point of the day. You had two downgrades coming in. Morgan Stanley, Credit Suisse, both downgrading the stock to underweight, to target price cuts by 30% and 15%. Agam, what does that bring to your mind?
Well, considering, I'm just going to tell you why Mindtree stocks has fallen today. We've had the management suggest that they could see a decline in revenues for the upcoming quarter, and they could also see a decline in margins, a contraction in margins, for a few reasons. So firstly is it involves project cancellations. Of course, we've also seen a slow ramp up in large deals for Mindtree, and they've also suggested some weakness in their UK operations, particularly the subsidiary Bluefin. These are some of the reasons why we could see some amount of weakness. Do remember that just about a week ago, I did consider Mindtree players, but well, that actually brings me to my next question, Rahul. What do we do with TCS and Infi? We're a lot of people now pegging TCS against Infi, but how would you go about these guys?
So as she was mentioning earlier, we've had an underweight sort of standing on the sector for about a year and a half now, I think since Feb or March of 2015. And the underlying thesis of that was that the global growth is going to slow down and discretionary spending is going to come down. And the third big piece of the puzzle was that increased automation, and Indian IT players were not necessarily ready to adapt to that. And you've seen most of that play out. I think if you look at general consensus now, is US will probably grow at 1.5–2%. And if you see, our IT companies' results over here are very closely related to the S&P profits, and almost 40% of that comes from overseas. And with crude also seeing a huge decline, I think that's a bit of a worry area as well. Our own stated call is that none of the frontline IT companies will report a double-digit growth this year. So I think you'll continue to see resets on the way down. And going into FY18, that growth will come down to 5% or even lower. In that context, I wouldn't even look at mid-cap IT.
In terms of tomorrow, the earnings are still not over. We are keeping an eye on ONGC, GAIL and BHEL tomorrow. And I suppose that is all that we have for today. I want to thank you very much, Rahul, for joining us today.
Thanks for having me.
And yeah, it was an absolute pleasure. And as for you guys, do come back tomorrow as we wrap the markets up for you and Bloomberg Print right here and right there. Stay tuned in.